afternoon, friends. I'm back again. Yesterday, I was giving you a little bit of a hint about where to put your money, what is the right kind of investment for your money to grow. I'll get a little bit into the details of that. Mutual fund is something which I already spoke to you about in yesterday's video. I would also want you to know a few other things concerning mutual funds. You would have often heard of concepts like large cap, mid cap, small cap stocks, mutual funds which are concentrated in large cap or multi cap or mid cap or small cap or whatever. Now, what exactly are these? What are these concepts? In India or across the world, there are various kinds of companies, various size, various industries, various kinds of commodities or services that they provide. Now, depending upon the size, how big a company is, what kind of a turnover, what kind of a share capital the company has, we tend to classify companies into large cap, mid cap and small cap. Mutual funds are also segregated according to that. There are mutual funds which invest across caps. There are mutual funds which only choose large caps or small caps or mid caps, as the case may be. Now, what are the pros and cons of large cap, mid cap and small cap? Each one of them has a specific advantage or a disadvantage. For example, if you want to choose a large cap stock to invest, always remember large cap stocks, which essentially involves companies which are very big in size, huge companies, the biggest ones, I would not take names. These stocks and these funds, they move slowly, just like an elephant in the forest. But these stocks have a very high degree of resilience. They would not react easily. They would not show any kind of volatility. So if you're looking for a stable and a very steady kind of a return, but over a longer horizon, then you should opt for large caps. In case of mid caps, the sizes of the companies that you are talking of or looking at, the sizes are smaller obviously than the large caps. Here you will see a very a very good spike in growth rates. You will suddenly see 30, 35, 40% or even more than that growth jumps. But then when the market goes down, the stock market that I am referring to, these stocks tend to nosedive. They plunge quite deep. So one needs to look at the risk appetite. In case of small cap companies, you would be dealing with companies which are relatively unknown, small. They may not be bad, they may be very profitable, they may be doing good in their space and industry, but they're yet not very reputed, or people do not have a lot of experience with these companies. Here you will see that the spectrum of jump is even broader. They will show you a negative growth of 20%, then a positive growth of 80% within a span of a year. Such is the fluctuation of the oscillation. So if you have a very high risk appetite and looking for a fairly large return, a return which is larger than the average market return, you can go for these companies. But for people who are starting in mutual funds, I have always recommended that to my fellow investors, that you should go first with a mix of large and mid cap stocks or mutual funds, as the case may be. Once you have spent about a couple of years or maybe 3 years dealing and dabbling in stocks which are large cap and mid cap, then through research, careful study and observation of the market behavior, you should go for the small cap funds or stocks. But they should be carefully chosen, because there can be massive dips in your fortune. And one more thing which I would like to add here before I conclude is that whether you are going for mutual funds or you are going for stocks, make sure that you are not pulling out money from your corpus or from your savings, which can be required by you in the near term or in the short term, by which I mean 3 to 6 months hence. You should only take that money to the stock market through the mutual fund route, which you would not need for the next 2, 3, 4 or 5 years. Because in the stock market, although the average growth is upward, in the middle term or in the near term there can be dips, in during which time if you're looking at withdrawing your money, you will have to book a loss, which means the amount that you will get at the time of withdrawal would be less than what originally was invested by you. So it is very important that whenever you think of putting your money in the mutual fund or stock market, both essentially the same, only the modus operandi is different. You should have a horizon of nothing less than 4 to 5 years at least, and upwards of as many years. The longer you can play in the stock market, the higher are your returns, and that's proven over the last 30 years. Keeping all these things in mind, keeping your greed in control, this is not a rags to riches story, friends. So be very careful that when you invest or when you decide to take your money out of comparatively safer things like bonds or maybe post offices or some government instruments or bank FDs, be very sure that you are not requiring that money to be recalled in the near term, at least for the next 3-4 years. It is not something which your your budget or your family expenses can be strained. No, don't take out those money. That is going to lead to stress, and you are willing to play on the longish term in the market, then obviously you will get a far superior return than any of the other asset classes, whether you take real estate, whether you take gold, or you take government instruments, and that's for sure. If you have any questions, as always, please feel free to comment, and I shall get back to you at the earliest. Thank you.